Hey, welcome to the office. Today I want to have a conversation with you about Roth conversions. This is really important for you to explore before December 31st, 2020. So let's come on back to the office and have a conversation. Hi, this is Daniel Peterson coming to you from my office. Hope you are well. I want to go over a couple of planning conversations today that are really important to consider. You might meet these qualifications and criteria. Tax planning is a very important part of what we do, and hopefully you've got a financial advisor or a planner that helps you with this process as well. If you don't, feel free to reach out to us at www.dpcpa.net, and we'll try to help answer your questions that you have. So today we're going to get a conversation going about Roth conversions. This is a year that's been in turmoil. 2020 is in the tank, and we really need to get this year closed out. What I'd like to do is basically analyze the tax situation in 2020. What is your income? If your total income is less than the standard deduction and you have qualified income, IRA money, 401k money, you might be in a position where you can take advantage of moving that pre-tax money out of the IRAs and into a Roth IRA and offer the government zero or very little tax. So this is an important conversation to have, and the timing is critical. We have to make these decisions now, and the calculations need to be done so that the right amount is converted and that you have enough time to actually get that conversion completed by December 31st, 2020. Because if you miss that window of time to convert the money, you've squandered the resources the government has given you through that standard deduction. So let's understand the game. The game is going to start with our income. Your income can be a variety of things: interest, dividend, capital gain, IRAs, pensions, severance packages, Social Security income. That income, ideally, is stable from year to year. But there are times where it's not. 2020 is one of those times. And so we want to look at this opportunity for a Roth conversion before we get to the end of the year. So from our income, we're going to take deductions. And those deductions are called deductions for AGI. At this point, I'm not going to get into the detail of those deductions because we're going to focus on two areas that are critical for this decision. Income minus our deductions for AGI gets us to this magical number called adjusted gross income. Adjusted gross income is used as a threshold in various phase outs. I won't say any more at this point. We'll do that in another video. Once we have our adjusted gross income, we have deductions from adjusted gross income. And that's going to be either your standard deduction or your itemized deductions. Today we're going to talk about the standard deduction since it's so high between now and 2026. That's going to generate what's called your taxable income. From your taxable income, your tax is calculated based upon your filing status, and that level of taxable income determines what tax rate applies. From your tax, we deduct your credits, and that determines the total tax that you will pay to the federal government. Okay, so today we're going to focus on income and our standard deduction. That's all we're going to focus on, and we're going to deal with this under a married filing jointly scenario. We can go over single scenarios or head of household scenarios as well. Again, reach out to us or your financial advisor, your tax planner, who can walk you through these conversations in more detail. So the government gives you a standard deduction of $24,800. That standard deduction essentially wipes out up to $24,000 of income. So if you have no income, but you have qualified money that you could have moved to a Roth IRA, but you don't, I will suggest to you that you've squandered an opportunity to move $24,800 to a Roth IRA tax-free. That Roth is never taxed. There are a couple of qualifications to that as far as holding time inside that Roth, but for all intents and purposes, that Roth IRA is not taxed. In a situation where you haven't done adequate planning, this married filing jointly couple has $25,000 of income and $24,800 standard deduction. They have $200 of taxable income. So they have $20 in tax. The unfortunate part here is this couple has a child that's eligible for a $2,000 child tax credit. While part of that tax credit is refundable, part of it is not, and they will lose that part of the child tax credit that's non-refundable. How could we change that situation where we squandered the standard deduction or where we've squandered a child tax credit? Well, we generate more income. Well, I can't get a job right now. You generate more income by moving that IRA money or part of that IRA money over into a Roth IRA, and you can do as little or as much as you want. The job of an effective planner is to help you calculate what is the best number for you to move over to your never taxed bucket of money to offer the least amount of tax. So the calculation here is for a married filing jointly couple, $45,000 of income will yield a $29 tax bill. Because the $45,000 is eaten up by the standard deduction of $24,800, that gives us a taxable income of $20,200. That $20,200 generates a tax of $2,029, and then we get to deduct a child tax credit of $2,000. So our resultant tax is $29. So we've moved $45,000 over into a Roth IRA, or if we have other income, some other lower dollar amount, we've moved that over to a Roth IRA for zero tax. Now that's effective tax planning. It can be done, but it has to be done before December 31st. So make sure you reach out to your financial advisor, your financial planner. Reach out to us, www.dpcpa.net, and let's schedule an appointment to have a conversation and talk about whether tax planning in a Roth conversion makes sense for you.